The image of Canada presented to the world is one of stability, vast natural resources, and a high quality of life within the G7 framework. However, if you strip away the polite, diplomatic exterior and look at the underlying structural data, a much darker reality emerges. Canada's economy is currently undergoing a process of internal cannibalization. It is an economy that has effectively stopped producing new value and has instead pivoted toward the circular trade of existing residential assets. To the casual observer, rising home prices look like wealth creation, but to a structural engineer of systems, it looks like a nation eating its own future. For the past 2 decades, Canada has systematically incentivized its citizens and its banking institutions to abandon productive investment in favor of a massive, leverage bet on the roofs over their heads. This has created a feedback loop where every dollar of growth is increasingly tied to the inflation of land values rather than the creation of new technology, infrastructure, or exports. This is the real estate trap. It is a mechanism that rewards rent-seeking and punishes innovation, and the numbers suggest we are reaching the terminal velocity of this model. The Canadian dream has been replaced by a mathematical nightmare, where housing has swallowed the nation's productivity. We are seeing a divergence between aggregate GDP, which continues to grow due to sheer volume, and GDP per capita, which is in a state of structural decline. This means that while the country as a whole appears to be growing, the individual Canadian is becoming poorer with every passing quarter. Before we dissect the specific machinery of this collapse, I invite you to join our investigation. Understanding these systemic inevitabilities is the only way to navigate the coming decades of economic stagnation. If you value deep dive analysis that goes beneath the surface of mainstream financial headlines, subscribe to the channel and hit the like button. This helps us continue to build these analytical models. By the end of this video, I will reveal the specific breakpoint, the exact mathematical threshold where the immigration to housing ratio fails, and why the government's current attempts to fix it are actually accelerating the structural rot. To understand how a G7 nation becomes a hollowed-out shell of paper wealth, we must first look at how the capital flow was diverted. To understand why the Canadian economy is failing, we must analyze the capital suck mechanism. In a healthy capitalist system, capital is a fluid resource that seeks the highest risk-adjusted return. Ideally, a significant portion of this capital flows into productive investment, things like software development, manufacturing automation, and research. These investments increase productivity, which in turn raises wages and real GDP per capita. However, Canada has created a unique tax and regulatory environment that makes residential real estate the most attractive asset class by an overwhelming margin. When you combine the principal residence exemption, which allows for tax-free capital gains on primary homes, with government-backed mortgage insurance through the CMHC, you create a system where the risk is socialized and the reward is privatized. This has caused a massive misallocation of resources. Instead of starting businesses or investing in the stock market, Canadians have funneled their life savings and their borrowing capacity into property. This is not just a housing crisis. It is a fundamental shift in the nation's DNA from an industrial power to a rent-seeking colony. The most devastating consequence of the real estate trap is the absolute collapse of business investment per worker. When capital is finite, every dollar that enters the mortgage market is a dollar that does not enter the venture capital market or the industrial equipment market. We are witnessing the death of the entrepreneur in real time across the Canadian landscape. If a rational actor in Toronto or Vancouver has $200,000 in liquid capital, the systemic incentives lead them away from starting a high-risk tech company. Why would they face the 90% failure rate of a startup, deal with complex payroll taxes, and navigate a Byzantine regulatory environment when they could simply put that same amount as a down payment on a $1 million investment property? In the real estate scenario, the bank provides 4-to-1 leverage, the government guarantees the downside through various insurance mechanisms, and the historical trend line suggests a consistent 7 to 10% annual appreciation. The math is undeniable, and that is precisely the problem. The system is designed to make doing nothing more profitable than building something. This internal drain has led to a catastrophic productivity gap compared to the United States. While American capital continues to flow into the Magnificent Seven and AI infrastructure, Canadian capital is locked in the drywall of suburban basements. This is a non-productive asset. A house does not produce more houses. It does not export services. It does not invent new patents. It simply sits there, absorbing maintenance costs while its price is bid up by the next person in the chain. This is the definition of a dead asset in economic terms. The banking sector reinforces this by prioritizing mortgage lending over commercial lending. For a major Canadian bank, a residential mortgage is a low-risk, high-volume product that can be packaged and offloaded. A loan to a mid-sized manufacturing firm to upgrade its assembly line is considered high-risk and requires significantly more capital reserves. Over 30 years, this preference has reshaped the national balance sheet. We have reached a point where the total value of residential real estate in Canada is now more than 3 times the nation's entire annual GDP. This ratio is not just unsustainable. It is a sign of a system that has lost its connection to reality. As productivity stalls, the only way to keep the GDP figure from shrinking is to increase the sheer number of people in the system. The Canadian government has attempted to solve a structural productivity crisis by using a blunt demographic instrument: massive, unprecedented levels of immigration. In theory, bringing in more people should expand the tax base and provide the labor needed to grow the economy. However, when a nation's housing supply is inelastic, meaning it cannot grow quickly enough to accommodate new arrivals, this policy ceases to be a growth strategy and instead becomes a population trap. The mathematics of this failure are stark and unforgiving. In 2023, Canada's population grew by more than 1.2 million people, a rate of roughly 3.2%, which is faster than almost any other developed nation and even outpaces many developing nations. Yet, during that same period, housing starts actually declined, struggling to stay above the 200,000 unit mark. This creates a structural deficit that is mathematically impossible to bridge through conventional policy. The result is a skyrocketing cost of shelter that acts as a vacuum, sucking every available cent of disposable income out of the hands of both newcomers and established citizens. When shelter costs rise faster than wages, the standard of living for the entire population begins to regress. This is why we are seeing the peculiar phenomenon of a rising aggregate GDP alongside a collapsing GDP per capita. The pie is getting larger only because more people are being added to the room, but the individual slice for every person is getting smaller. In a functioning system, infrastructure and housing are built ahead of demand. In Canada, the demand has been artificially inflated to support a debt-heavy banking system that requires a constant influx of new mortgage holders to maintain the valuation of its assets. This has placed immense pressure on social services, healthcare, and transit, none of which were scaled for a 3% annual growth rate. The tragedy of the population trap is that it turns a potential economic strength, human capital, into a source of systemic fragility. Instead of immigrants coming to Canada to build industries, they're being used as fuel to keep the real estate market from correcting. This creates a cycle of resentment and stagnation that threatens the very social fabric the nation prides itself on. The math is simple. You cannot add 1 million people a year to a system that only builds 1/5 of the necessary housing without causing a total breakdown in affordability. For the past decade, the Canadian consumer has been living on HELOC Hero1n. A home equity line of credit, or HELOC, allows a homeowner to borrow against the theoretical paper wealth of their house. As prices in markets like Toronto and Vancouver surged by double digits year after year, millions of Canadians found themselves sitting on hundreds of thousands of dollars in equity they didn't actually earn through labor. This created a powerful wealth effect. People felt rich, so they spent money. They used HELOCs to buy luxury SUVs, renovate kitchens with Italian marble, and fund vacations they couldn't afford on their stagnant salaries. This created a synthetic layer of economic activity. Much of Canada's retail and service sector growth over the last 10 years wasn't driven by rising productivity or exports, but by people effectively eating their houses. The problem with this model is that it is entirely dependent on two factors: ever-rising house prices and ultra-low interest rates. When the Bank of Canada began its aggressive rate-hiking cycle in 2022 to combat inflation, the HELOC Hero1n supply was abruptly cut off. Suddenly, the cost of servicing that debt doubled or tripled, and the equity that fueled the spending spree began to plateau or even shrink. This exposes the zombie household, a family that appears middle-class on the outside, but is functionally insolvent once interest rates return to historical norms. The systemic implication is a massive contraction in consumer spending that will drag on the economy for years. This is the debt overhang. Unlike a business loan that might fund a new factory, a HELOC used for consumption leaves behind nothing but a debt obligation and a depreciating asset in the driveway. The Canadian economy has become a giant leveraged bet on low interest rates, leaving it uniquely vulnerable compared to its G7 peers. When the leverage starts to work in reverse, the downward pressure on the economy is just as intense as the upward surge was during the boom. We are now entering the withdrawal phase, where the reality of debt meets the fiction of paper wealth. While domestic policy and debt explained much of the crisis, we cannot ignore the snow washing phenomenon. For decades, Canada has been perceived as a safe laundry for global illicit capital. The term refers to the process where dirty money is cleaned in the pristine snow of the Canadian real estate market. Due to incredibly weak transparency laws and a lack of beneficial ownership registries, it has historically been easier to hide the true identity of a property owner in Canada than in many offshore tax havens. This attracted billions of dollars in capital from overseas, much of it looking for a safe place to park wealth away from the prying eyes of foreign regulators. This capital isn't looking for a yield, it's looking for a vault. When billions of dollars enter a market with the sole purpose of hiding, price is no object. This inelastic capital outbids local families who are constrained by their actual wages, effectively decoupling the cost of housing from the local economy. In cities like Vancouver, the Vancouver model of money laundering became a systemic infrastructure. Money would flow from international criminal organizations through local casinos and then be cleaned by purchasing high-end real estate. The impact on the housing market was catastrophic for the average resident. It created a phantom demand that pushed prices into the stratosphere, which then trickled down to the mid-market and entry-level segments. Even if only 5% of transactions were illicit, those transactions set the comparable prices for every other home on the block. The Canadian government and financial institutions were, for a long time, incentivized to look the other way. The influx of capital made the banks look healthier, boosted provincial tax revenues through land transfer taxes, and kept the construction industry humming. It was a victimless crime until the children of the middle class found themselves priced out of their own cities. The institutional blindness to snow washing allowed a global criminal element to become a structural pillar of the Canadian GDP. Now, as the nation tries to implement transparency registries, the capital is starting to freeze, but the damage to the price structure is already permanent. The stability of the Canadian financial system is often cited as a point of national pride, yet an investigative look at the balance sheets of the big six banks reveals a dangerous concentration of risk. In a diversified economy, a bank's loan book reflects a broad spectrum of activity: commercial enterprises, industrial expansion, and consumer credit. In Canada, the Big Six have effectively become massive mortgage real estate investment trusts with a banking license attached. Currently, residential mortgage debt in Canada stands at a staggering $2.1 trillion. For the major banks, exposure to the residential housing market often exceeds 50% of their total loan portfolios. This concentration creates a systemic vulnerability. The banks are no longer just lenders to the economy. They are hostage to the valuation of residential land. If housing prices were to undergo a significant, sustained correction, the resulting equity wipeout would not just affect homeowners. It would impair the core capital of the entire Canadian financial infrastructure. This is why the federal government and the Bank of Canada are so hesitant to allow any meaningful price discovery. To let the air out of the housing bubble is to risk a catastrophic deleveraging event that would freeze the nation's credit markets. This risk is compounded by the astronomical household debt-to-disposable income ratio, which has hovered around 185% in recent years. This is one of the highest levels in the G7, significantly higher than the levels seen in the United States prior to the 2008 crash. The stability of the Canadian banking system is, therefore, predicated on the assumption that employment remains high and interest rates remain manageable. However, as the HELOC Hero1n era ends and mortgages renew at significantly higher rates, the buffer for these banks is thinning. The systemic implication is a credit crunch in the making. Because the banks are so heavily weighted toward housing, they have less appetite and less regulatory capacity to lend to the small and medium-sized businesses that actually drive innovation. The banking system has become a reinforcing mechanism for the capital suck, funneling the nation's liquidity into a single, non-productive asset class, while starving the rest of the economy of the oxygen it needs to grow. We are looking at a financial architecture built on a single pillar. If that pillar cracks, the entire structure descends into a liquidity trap from which there is no easy escape. While capital is fleeing productive sectors, Canada is also facing a secondary, perhaps more permanent, crisis, the exodus of its most talented human capital. The brain drain is no longer a theoretical concern. It is a mathematical inevitability driven by the housing-to-income gap. For a young engineer, developer, or medical professional in Canada, the economic calculation is increasingly grim. In cities like Toronto or Vancouver, a top-tier salary of $120,000 CAD, which represents the top 5% of earners in many brackets, is no longer sufficient to purchase a modest entry-level home without significant intergenerational wealth transfer. When that same professional looks across the border to the United States, they see salaries that are often 30 to 50% higher in USD, coupled with a cost of living and housing that is significantly lower in many tech hubs. The result is a great talent export. Canada is effectively subsidizing the education of its youth only to watch the most productive among them flee to the U.S., where their labor can actually build equity rather than just servicing a landlord's mortgage. This loss of talent creates a negative feedback loop for national productivity. As the smartest and most ambitious individuals leave, the domestic pool of entrepreneurs shrinks, leading to fewer startups, less innovation, and lower business investment. This further depresses wages, making the housing crisis even more acute for those who stay. The housing market has become a tax on ambition. In a healthy system, the goal of a young professional is to create value and grow wealth. In the Canadian system, the goal is simply to get into the market, a mindset that shifts focus from creation to survival. This cultural shift is devastating for long-term growth. When a nation's best and brightest are spending half of their post-tax income on rent or a mortgage for a 400-square-foot condo, they have no capital left to take risks or invest in their own ventures. Canada is trading its future innovators for real estate speculators, and the data suggests that the innovation gap between Canada and the U.S. is widening at an accelerating rate. The brain drain is the final stage of the capital suck. First the money leaves, then the people follow. When we synthesize these individual mechanisms, the capital suck, the population trap, the HELOC Hero1n, and the brain drain, we arrive at a singular, inescapable conclusion. Canada has designed a system that optimizes for short-term paper wealth at the expense of long-term structural viability. This is not a series of unfortunate policy accidents. It is a coherent, self-reinforcing architecture. The government cannot lower housing prices without bankrupting the banks and the aging voting bloc that relies on home equity for retirement. Conversely, they cannot keep prices rising without further crushing the productivity and standard of living of the younger generation. The system is trapped in a stagnation equilibrium. To maintain the illusion of growth, the nation must import more people, which increases housing demand, which increases the capital suck, which further hollows out the productive economy. This is the definition of a Ponzi-style economic structure. It requires constant new inputs of new residents and new debt to prevent the existing layers from collapsing. The inevitable result of this synthesis is a lost decade, similar to the stagnation seen in Japan after its own 1989 real estate collapse, but with the added complication of high inflation and crumbling infrastructure. As GDP per capita continues to decline, the social contract begins to fray. The middle class, once the backbone of Canadian stability, is being bifurcated into equity owners and renters, creating a new form of neo-feudalism. The real estate trap is now the primary driver of Canadian life, dictating where people live, if they have children, and how they vote. We are not looking at a market that is broken in the traditional sense. We are looking at a market that is performing exactly as its incentives dictate. It is a machine designed to convert productive human effort into land value. Unless the structural incentives, the tax exemptions, the banking regulations, and the immigration to housing ratio are fundamentally dismantled, the system will continue to behave this way until it reaches a point of total exhaustion. The Canadian housing crisis is often discussed in mainstream media as a problem that can be fixed with a few policy tweaks or a temporary surge in residential construction. But as we have demonstrated through this systematic investigation, the roots of the crisis are far deeper, embedded in the very plumbing of the national economy. We are witnessing the final stages of a model that has prioritized land value over human ingenuity and asset inflation over industrial output. The break point for this system occurs when the carrying cost of unproductive debt exceeds the total surplus productivity of the labor force. We are mathematically approaching that threshold. When the cost to simply exist in a space, whether through rent or a mortgage, consumes more than half of the median household's gross income across the entire nation, the social and economic gears of the country begin to grind to a halt. At this point, no amount of immigration can stimulate aggregate growth because the new arrivals are immediately neutralized by the sheer cost of shelter, turning potential contributors into debt-servicing units from the moment they land. Canada's path forward is fraught with systemic risks that leave no room for easy solutions. To truly save the economy and restore productivity, the government would have to allow a massive, painful deleveraging, which means permitting house prices to fall to a level consistent with local wages. However, because the banking sector is so heavily exposed to residential mortgages, a true correction of that magnitude would likely trigger a financial contagion that the nation is ill-prepared to handle. Therefore, the most probable outcome is not a sudden, therapeutic crash, but a lost decade of grinding stagnation, a period where real wages continue to fall, innovation continues to flee south, and the quality of life for the average citizen slowly erodes under the weight of debt. The real estate trap is a cage of the nation's own making, built one brick of debt at a time. It serves as a stark cautionary tale for any G7 nation that chooses the easy path of asset inflation over the hard work of building a productive, innovation-led future.